Hello, my YouTube friends, and happy Saturday. I hope you all had a great week. Interesting Fed comments. If you stick around to the end of this video, I'm going to talk to you a little bit about personal issues and why I'm scared of dying and the things that go through my head. And to be fair, it'll wrap into the usual financial information, so stick around. Should be a really good video today. Good morning. My name is Adam Kahn, and this is Investing with Adam K. So, pretty interesting week ending on Friday with the Fed announcement and Powell speaking and talking about how it's time to reverse direction and start cutting rates. So, does that mean all green light and things are good to go? Well, if you want to ask my opinion, I say yes. Typically, when the Fed is cutting rates and it's a non recessionary period, that's really good for the stock markets and real estate and things of that nature. And to be fair to Powell, the reality is I think it is the right time. PCE has finally dropped under 3%, getting to their 2% target. And now, just like you guys, I am not a fan of inflation. I hate going to the restaurants and it's super expensive. My wife wanted to see a concert, and I think she told me the tickets were over $1,000 a ticket. And that just seems absurd to me as somebody who used to spend $15, $20 to go see U2 when I was a kid. Now, I'm old, and inflation over time obviously changes prices, but agreed, it seems expensive. But understand, a 2% inflation rate does not mean deflation. I've talked about this a few times, and I want to be clear about that. That does not mean we go back to prices that it was 4 or 5 years ago. It means the pace that inflation slows down. The government, and particularly the Fed, is not trying to cause a recession and is not trying to cause deflation. What they would like to see is inflation slow down, continue to go higher because that's a natural flow of a good, strong market, but be in a pace that's more reasonable for what people can afford to pay. The other thing that I've noticed is when I go to the supermarket, if you pay attention to the sales and get things that are discounted, things are really reasonable. My wife bought 5 small watermelon yesterday, not the giant ones and not tiny, but the ones that are probably 5, 7 pounds a piece, maybe 8 at most, for 97 cents a piece. That didn't exist during COVID and when the inflation was going through the roof. I felt like nothing was on sale. And while some things have gotten exceptionally expensive, if you pay attention and shop around, you find things that are discounted and really reasonable. Now, if you're looking for investments, I just don't see any big collapse coming. If you're looking to buy a house and you can afford it, I would just say stay in budget. Interest rates have come down already, but be careful. The Fed cutting rates does not necessarily mean that mortgage rates fall further. There seems to be a disconnect and a misunderstanding with this. The Fed controls the overnight lending rate when they talk about cutting or raising interest rates. What that is the rate that banks borrow from the federal government on a 1 day loan overnight to stay liquid. That is not a 10-year bond. Now, they have other weapons in their arsenal. If they need to buy bonds, they can. If they need to buy mortgage-backed securities, they can. They can do quantitative easing. They can do quantitative tightening. That is not their only weapon, but people seem to pay attention to it and think when the Fed cuts rates, all of these things become less expensive. What I envision is as they cut rates, the bond yield will start to normalize. If you don't know, it's been abnormal, so to speak, but it's been inverted, meaning that you get a better rate of return on a 2 year note or a 1 year note than you may on a 10-year or 30-year loan. And just think about it logically. If I wanted to borrow money from you, friend to friend, person to person, and I wanted to borrow it from for 1 year, what interest rate would you want to get from me? And then change it to I wanted to borrow it for 10 years or 30 years. In the example where I'm borrowing it for a longer amount of time, wouldn't you expect to get a better return on your loan to me? Wouldn't you be charging a higher rate of return? Well, that is a normal yield curve that you would see it, rise like a, I don't want to say a U shape, but a curve that goes up gradually as it goes further into the longer timelines. Whereas inverted, the opposite is going on. if you're only borrowing it for a year or two, you're getting a higher rate of return. Why is that the case? Well, that's the case because the Fed has been holding the overnight lending overly restrictive, causing the overnight lending rate to be higher than what people expected to be further out 10 and 30 years from now. So it may have lasted a year or two, but now that they're cutting rates and it's coming back down, that doesn't necessarily mean that you'll see the 10-year bond or the 30-year bond continue to fall at the same pace it did in advance of them actually cutting the rates. The other thing is when the Fed does cut rates, typically the bond market has already moved in anticipation for that. The banks and the traders are well aware of what the Fed's intentions are. Powell's been really clear about sharing that and being pretty transparent about his plan, which allows them to move in advance of the rate cut. So by the time the rate cut actually happens, the market has already moved because they expected it. So when the cut comes along and the news talks about the Fed cut rates, oftentimes you see the bond market move in the opposite direction because the traders have already put on the trade, and now that the the retail investor starts to get in because they see it, they're usually getting in behind the actual move of the market. The other thing is they've actually done a really good job, and I don't see the mortgage rates in particular just collapsing and going back down into the fours or anything like that unless something starts to happen where there really shows some cracks in the economy. Why? Because there's just no need to. There's no reason for the Fed to step in and support the mortgage-backed securities, causing there's actually a margin that increased as the Fed got out of that market. So just generally, this is not actual like factual, you can count on it, but for the most part, for many years, if you looked at a 10-year treasury bond and saw what the interest rate on that was, you could add about, not exactly, 2% to it, and that's about where a mortgage rate would be. When the Fed stopped buying the mortgage-backed securities, that increased to 3%, and it's kind of stayed there for the past couple years. I think as the banks get more comfortable that the economy is doing okay, you'll see that margin come in, which is where you'll see the improvement on the mortgage rates, but you may not see it because the bonds move that much. And as that happens, let's talk more exciting. What does that do for the stock market? Well, it changes things a lot because as the Fed cuts rate, those borrowing rates actually do directly impact the companies that are borrowing because they're borrowing on shorter term loans. They're not looking at mortgages. On top of that, if you have a company that's paying a dividend, as investors can no longer get the same 5% return as the Fed starts cutting rates on the bond market, there's a good chance they're going to start moving that money into stocks. And if they wanted a return and they wanted yield, they may look to dividend stocks and hope to find a 4 or 5% yield in some of the companies like UPS is paying a 5% return, or things that are even paying a 3% that have been out of favor, like an Archer Daniels Midland or Target, which actually had phenomenal earnings. I hope you guys have been following my discussions on Target. I'm still super bullish even at these prices because they're actually the quarter was great. The comments by the CEO is essentially saying exactly what he was hoping, which is they're selling products, they're growing revenue, and even stores are doing really well with year over year growth and more traffic and everything else. And while the news and media push the stock price too low because of the woke politics and the store closers and everything else, the reality is in the end, the earnings will dictate where the stock goes. And those of you who've been watching me talk about Boeing for such a long time, again, they keep putting out whatever negative information they can. It presses the stock down to 170 type of level, maybe a little bit below on Monday when the market corrected. But I still see it in this range and see it as a great opportunity. And then when they finally get past all the negative media and people kind of forget, which is where I think we're getting at this point, you'll see it just start to drift higher because the sellers will be completely done. My only concern with the equities market is on Friday after Powell spoke, the investors and the people I saw on CNBC were a little too optimistic, which makes me think there's over exuberance, to use a Greenspan term. But I think they're right. So it's really hard for me to argue it and think it's gone too far. I still don't go out and go to a restaurant and have the waitress talk to me about a house that they bought because housing's just going higher, or mention some stock that's been going up a whole lot because they're investing in it. I don't think most of the world is paying attention to this stuff, which is typically when it keeps drifting higher. I think if we have a couple more years of this 20% return, which is extremely high for the markets, it'll finally draw people in where it'll go too far and have a real spike at the end for a correction. But in the meantime, I think corrections are going to be short lived, just like it was. I'm still a little surprised how quickly it's reversed. I don't know about you guys, but I know my portfolios are actually making new highs, which shocks me how quickly that's happened. And I hope it just continues. Where I do think the markets have it wrong, though, is I just don't see the Fed cutting things super quickly. And if they do, I'll start believing in the hyperbole and the comments about them doing it to try to push the election the way that they want, which I find is hard to believe. I don't think they're really political, but maybe they are. But there's no reason for Powell and his team to be panicked and cut fast. Like, there isn't. As long as nothing is breaking and the economy is stretched but not collapsing, why would they cut rates any more than a quarter point? And not only that, maybe they do two cuts for a quarter point each or a third, and possibly even then pause after that. Because if things start to break, that gives them room to actually go much quicker. If they go really quickly right from the beginning, they may get down below where they want to, and not have room to start doing things to catch the economy if it gets into trouble. Currently, it's not really in trouble. They just see that the inflation is slowing. They see some cracks in the unemployment, and they just don't want to get it out of control, so they want to stay ahead of things. If they do it right, there's really no reason to cut 200 basis points like people have talked about over the next 6 months, or whatever the things that seem to be getting ahead. And I find it pretty common that the markets get overexcited, get ahead of things, and then there'll be lots of disappointment when they only cut a quarter. Maybe the market reacts poorly, but the reality is that's a good thing. The economy is okay. Cutting a half makes me think that they're going to go too far too quickly, possibly even inflate the inflation again, cause new problems, push housing prices up really quickly. Whereas if they just go down a quarter, and then another quarter at the next meeting, and possibly even a third one, but I think two is just fine, and then pause to see how the economy does over the next few months and what the data shows, and then maybe another one or two to do 100 basis points total. I just don't see the need to go any further than that if things are going along just fine. There should be some interest in overnight lending. Bonds should pay a return, so you shouldn't have to go too far. And maybe that actually causes it to continue down to their 2% goal, at which time maybe they cut it a little bit further. Then along the way, if things start to break and you have some bank failures or actual large companies having trouble or things of that nature, that still gives them room to do an emergency 50 basis point cut, or a couple of really quick ones over two meetings, or whatever is needed over time if things start to crack. But as long as they're not cracking, what's the hurry? So this overexcitement of the markets and the overreaction, maybe equities pull a little bit back, but I don't think so. I just think maybe. And maybe the bonds have gotten a little ahead of itself, which isn't uncommon. I think they're right in terms of the long term. I think over the next 2 or 3 years, sure, we might be 200 basis points lower, but it's been a slow journey already. There's no reason to speed it up out of impatience. They've done a phenomenal job. I hate to admit it because it's really easy to blame the Fed for everything, but to be fair, economy is doing well, GDP grew, unemployment hasn't gotten out of control. Earnings for some companies are doing great, others aren't doing so great. And for the most part, things are okay other than things cost more than they used to. And we all hate that. I would love if things were half the price of what they used to be, but they aren't. I also took a closer look at the new CEO of Starbucks, and I'm actually pretty excited to see who's coming in and what he's done in the past. I didn't realize he was with Taco Bell before he went to Chipotle, and he's done phenomenal with both of them. What I'd expect to see is him starting to limit the menu a bit and work on helping the baristas to be able to get out products quicker. I think Starbucks has lost their sight and where to go, but looking at Nichols and how he's maintained and grew other companies, he's simplified things to make it a better process. And I think Starbucks has gotten to the place where everything can be customizable, that it makes it really difficult for the employees. So if he comes in, restructures things, works on speed, when I look at those long lines at those drive-throughs, I think that could really increase their sales. My understanding is he's also really careful about going through with a fine-tooth comb about every penny and where it's being spent and how to really maximize profits. I think this is going to be great for Starbucks. At first, I thought that the move up was a little overly done, but when I look at his history, I don't think it is. I'm still concerned that, 2 quarters out or 3 quarters out, if things haven't rapidly changed, because a stock is like a big steamship. It doesn't just turn on a dime or a nickel in Nichols' case. Anyway, they don't just turn that quickly. So I know he'll be forgiven for whatever the first quarter's earnings are. But at the second one, are people and investors going to overreact because he hasn't turned the company around in 5 months or whatever the timeline is? And same with by the third quarter he's been there. Are they going to get a little too impatient, driving that stock price back down to the $70 range before things finally start going in the right direction and the things he implements start really showing in the numbers? Like, that's my only concern. But on the flip side, I think they have a real opportunity to really increase the company and grow it like Chipotle did over the years. He went into these companies when they were struggling and having problems and was able to really turn it around by simplifying things, making it easier on staff, and focusing on the high profit margin things and pushing those products to help grow the company. When I go in Starbucks, they've gotten into way too many things. They've expanded way too much. It's super confusing. I think we'll see what he does, and I'm really excited to see if he's able to do what I think he could. And the other companies that are still in my seems like a fair price companies and good opportunities still are all of Meta, Google, and Amazon. I think that Google in particular, with what's going on with the Department of Justice, is keeping it undervalued because there's a fear of they may be split up. The reality is if they are split up, I think that's going to be better for shareholders and actually give out a bunch of, not equity, but value from separating them into different companies. I think by being one company, it keeps it kind of undervalued in one way. And this nervousness that it may be split up, well, I don't think anybody should be nervous. I just see it becoming a better bargain. Meta, on top of it, has like crushed their earnings every quarter and keeps growing at a great pace, but the stock isn't really going up at the pace that I think it should be, which just gives you more time to buy it. I think it's a great company. I'm really interested to see what happens with Nvidia on Wednesday. I think that I don't think anybody questions that they're going to have great earnings. The question is, are they going to be able to continue to grow those earnings at the pace that they've been growing it already? Because it's been a long run as it's been. I think they're going to surprise, and the stock's going to have a nice big rally from there, just because I think there is still a lot of nervousness that they can't continue. And in the meantime, they are. Like, I don't think anything's going on any differently that's causing them to slow down at the moment. I think they still have time to continue to grow, and I guess we'll see on Wednesday. I still hadn't sold a call just because of my thought on it. It might be a huge mistake because if the stock ends up not doing well and going lower after the earnings, well, miss the opportunity of the added volatility, so the premium and the price of the option to be able to sell the call here. But just my opinion on the stock, and I'd rather wait until after the earnings. For those of you who are watching that video in Croatia where I was just talking about the return, to be fair, if I sold the 134 call or 131 call for about a month out, I would be able to collect another $6. I just thought that that was a little too little for that type of move because the stock's already at $128. Maybe a mistake, but maybe it's not. And the thing is, to be fair, if I just stuck with it, the whole goal and what I was trying to get across is on 300 shares, selling one call a month, getting your $6 premium. If you're able to do that, because it's not always so simple, you're getting about a 19% return on a rather large position, only risking getting taken on one of the stocks, one of the share, 100 share lots or whatever you want to call it. And if you wanted to, you could then reverse and look at selling a put to continue to get that income stream. My only concern and where I have trouble with this stuff, and this is just personal, is it's hard for me to sell a put on something that I'm already long like that, because if the stock price falls, I don't know that I want to be buying more shares on the way down. And then if the stock goes up, I won't be able to repeat and continue to get the earnings. Very easy for me to sell a call against a position like that, but reversing when I get taken is a little bit tougher. Now, one mistake that I've made, and I'll be happy to share it, is in the portfolio that I never touch, and I promised myself that I never touch. I ended up selling a call in Meta and getting taken on that, and I kind of regret it, which is part of the reason it's one of my picks, and I think it's going to continue to go higher. I find when that stuff happens, it gets really difficult to be able to get back in, and you tend to lose those shares and sit there kicking yourself for the next 10 years as the stock continues to go higher. So that's why I still like Meta, is just my own mistake on it. So why am I scared of dying? And I'm not really scared of dying. What I worry about is, and this will sound so stupid and why I say it's portfolio related, is not having things set up properly where it becomes an easy transition for my family. I love markets and I like to trade, and it's what I keep up on. I read a ton. I watch everything I can. On the weekends, I'm studying and going over things and getting into where I can find value in everything else. Now, when I try to show even just the portfolio to my wife, she just looks at me like I'm nuts, says she doesn't want anything to do with it, that she's not worried about it, and so on and so forth. But the reason I'm trying to show her is I want her to be able to handle it if something happened to me. Not that I expect anything to happen to me, but the years go by really quickly, and you continue to put these things off, and you just never know what could happen. And by the time I take care of it, am I too old and it changes and doesn't matter? So, what I really think I should do, and I don't plan on doing it, even though it's what I think I should do, is rotate everything into dividend paying stocks so that she could just quantify exactly what comes in on, I don't want to say exactly a monthly basis because they don't get paid quite like that, but let's call it an annual basis, and know that that's what she has to live on and be able to budget accordingly. I don't really do that because I still see better growth opportunity in a stock like Amazon or Meta that pays a tiny dividend, or Google that pays a tiny dividend, and even Microsoft, than moving into Bristol Myers and Pfizer, which I have both of those, but moving the whole portfolio into slow, boring stocks simply to have it easier if something happened to me. Maybe I need to write down exactly how I would want it transitioned if something happened so that that change could be made and she could then do the math for it. The problem with that is I don't know that it works so easily and the prices change, so the math may not make sense. So I do worry about that because if something happens to me and she's worrying about how to take care of those arrangements and has all these other things on her mind because I cover a lot of the dealing with the bills and the things like that, and her trying to learn how to do that at the same time inheriting this portfolio that's got options positions and trades on that really aren't intended to be investments, they're more of a trade, and not her knowing exactly what to do with that just is going to make it rather difficult. Whereas if I owned a whole slew of the Coca-Colas and Johnson and Johnsons and other companies that I'm not really worried what's going to happen with them over the next 20 to 40 years, and that they'll still be okay to pay their dividend. And if I diversify across enough of them that I'm not worried if one goes out or the other, that they'll be just fine and be able to live off of that. In some ways, it would be a lot smarter. It wouldn't be as much fun for me, and it would be kind of boring in a lot of ways, but I do worry about that and think about it a lot. So I apologize for getting a little personal, sharing some of this, but maybe some of you are in the same position and think about it as well. Maybe not. Maybe I'm the only one that, gets oversensitive and worries about finances all the time, no matter what. Really, I had seen a video, he does it every week, one of my favorite YouTubers of ex-dividend investor, and he had talked about that in one of his videos from years ago when he was having surgery done. And so I know others do think about it. So anyway, before I go, do me a favor, save money, invest it. Remember, this is not financial advice. You need to do your own research, reach out to a financial planner, make your own decisions. You shouldn't be listening to me. I am just sharing what works for me, and this is just for entertainment purposes only. But I wish that you all would put money away, whether that's in stocks, whether that's in real estate, whether it's in collectibles, whatever it is, because I think that as you get older, you'll be really happy to have that nest egg. It makes a big difference in terms of being relaxed and enjoying as you get closer to retirement and not stress so much about all this stuff. Again, do me a favor if you haven't already, hit that subscribe button, smash the like button, make some comments, tell me what you guys think. Do you worry about dying and how your portfolio is set up? Do you worry about dying at all? Do you, what did you think of the Fed this week? I think it's great that they're reversing, and we'll see what happens with the markets. Have a great day. Have a great week. Maybe I'll post sometime during the week. If not, we'll see you next Saturday.